Hello, this is Mike Smith at the brokerage, and this morning we're going to be conducting a very brief 30-minute or so webinar on some tax tips that you as insurance agents can use to help put into play for marketing purposes to get you into the door for decision makers to purchase additional products such as life insurance for additional retirement planning or for death benefit. As you can see here, the lines have been muted so that we can keep the background noise to a minimum. If there's a way that you can ask us a question, please use the GoToWebinar box on the right-hand side. We'll do our best to answer those questions for you either during the webinar or we will send these to you as a follow-up. And the follow-up will be sent to you sometime this afternoon along with all of the resources that we reference, so you don't have to worry about trying to outpace yourself with writing a bunch of stuff. We're going to give that to you. And then the recorded webinar will also be posted at the Brokerage Inc. So again, our topic is taxation. Everybody's got taxes on their mind. So we're going to talk a little bit about taxes today and how to help the marketers that are on this webinar use these tax tips to identify additional products that they can use and put into play for sales strategies. Our disclaimer here is we're not a CPA firm. I am not a CPA. I'm just a marketing guy, hopefully sharing some ideas that I see when I read things that make me wonder, wow, what business owner could use these ideas and how can we put that into play? And so realistically, this whole format is simply about tax tips for you to try to brush up on. Some of you may already know some of this stuff and it may be a good reminder. You forgot it. You may want to start using it again. And for other people, it may be brand new information and rather eye-opening because some of the way the tax code is structured, there are still some good ways out there to market life insurance, especially in the executive arena. So we're going to start out this morning just to kind of go back over a few quick things related to the Affordable Care Act, and that's only going to be just to give you a couple of real quick ideas on these forms that are being sent out that are confusing everybody, and these comments are only designed to try to just give you a record where you can send either yourself for additional information or your customers that you work with for additional information on some of these new forms that are created under the Affordable Care Act. We're going to spend the majority of our time, though, talking about how to use certain tax codes to get in front of business owners or other people who have assets that need to perhaps either buy life insurance for the first time, buy additional life insurance to offset what they may need, or for some people to put money away on a tax-favored basis to supplement retirement dollars. We're going to focus our attention on a code section 162, kind of known as a bonus arrangement for executives, give you a couple of sales ideas there, and then I'm going to wrap up by using a tax return and how you can use that 1040 tax return to go in and look at certain line items and be able to identify if they have a potential tax exposure, or you could help them by moving some of that money that they have into a better, more tax-efficient vehicle that you might be able to make a sale and help someone at the same time. So first, a couple of quick things that you as an insurance agent need to be aware of if you haven't been made aware of this. These are certain things that you as an agent can deduct. The money that you pay and receive to maintain your license each year or every other year is deductible. You also can deduct the continuing education expenses, anything that you pay towards maintaining that insurance license. So if it's an education or if it's a certification, you can write those things off because that would help to improve the skills necessary to be an agent, or in some cases with certification for things like long-term care insurance, annuities, Medicare Advantage, ACA, being able to write off those expenses for computer-based training as well. And any, of course, fees and materials related to the traveling in order to get that education and maintain your license and compliance. All of those expenses can be deducted. The mileage that you use to go to and from appointments, that is also a deductible expense. And there is also a reference, a hyperlink at the bottom of this slide where you can go and download this form from the IRS, and it'll give you all of the updates about the different things that are contained within the slides here, the mileage expense in specific. And also just a tip for you, one of the staff members here at the brokerage discovered a mobile app called Mile IQ that you can download your phone to help you track your miles, and that can help you to separate what's a personal expense versus a business expense, and help you if you ever are to be audited. And the last thing about you as a health insurance, life insurance professional, you can actually deduct operating expenses if you're self-employed for necessary and ordinary business expenses that include things like office supplies, laptops, computers, business cards. And I will also tell you that there are some additional, more liberal deductions for home office expenses, which usually was sort of a taboo no-no where it may trigger an audit. People would be very, very shy about deducting home office expenses. But the IRS recognizes now that there are many more men and women out there in the workforce that are actually working from their house. And so those possibilities for tax deductions have been liberalized to a point where it's not going to trigger audit. So you might want to revisit that. And of course, the link, again, the reference at the bottom of this slide if you want more information on that. Health insurance. The Affordable Care Act created some new tax forms, Forms 8962, and then Forms 1095-A, -B, and -C. What do these forms mean? Well, let's start with the Form 8962. This is for anyone who receives a marketplace subsidy and must file a tax return with the IRS each year. They're going to need to file Form 8962, which is regarding their premium tax credits. So the IRS created this new form, and then anyone who receives subsidies has to use the Form 8962 to reconcile their actual income for the year with the level of assistance they received from the marketplace. In order for you to complete Form 8962, you will need Form 1095-A, which is called the Health Insurance Marketplace Statement. So if your clients purchased health insurance on one of the public exchanges or marketplaces, they will receive Form 1095-A. 1095-A is used to complete Form 8962. And if you or your clients received a subsidy and you did not receive a Form 1095-A, then you need to contact the marketplace, not the carrier, but the marketplace, to see if you can get a second copy of the 1095-A. The 1095-A is used to report to the IRS, to report certain information about individuals who enrolled in a qualified health plan through the health insurance marketplace on exchange received a subsidy. And the individuals allow them to take the premium tax credit and then reconcile the credit on their returns with the advance payments of the premium tax credits, and then file an accurate return. So if someone has been over-subsidized or under-subsidized, this Form 1095-A put on the 8962 as amended to your 1040 is what you would use to either get a tax refund because you were under-subsidized or perhaps have additional monies owed if you were over-subsidized. So that underscores the purpose that we have to make sure that we're reporting an accurate estimated income when people are applying for subsidies. Otherwise, there could be a nasty surprise here. Now, the other Form 1095-B, health coverage, is used to report certain information to the IRS and to taxpayers about individuals who are covered by minimum essential coverage and are therefore not liable for individual shared responsibility payments, also known as penalties. So again, a person who has an MEC plan, minimum essential coverage, will not have to pay penalties. Form 1095 will be required for you to prove that you did have that MEC coverage type in place. The due date for furnishing the 2015 Form 1095-B was changed recently from January 31st of 2016 to March 31st of 2016. And as a result of these extensions, some individuals might not receive Form 1095-B or Form 1095-C by the time they file their 2015 tax returns. And there was a notice 2016-04, which is further guidance. And again, there's a link referencing this information at the bottom of the slide. Last thing on health insurance, the 1095-C is filed and furnished to any employee of an ALE, which is an applicable large employer member who's a full-time employee for one or more months of the calendar year. ALE members must report that information for all 12 months of the calendar year for each employee. So that is the employer's responsibility, if they are an applicable large employer, to supply the Form 1095-C to the employees, whether they work 1 month or for the full year. And this is also something that is a potential liability for an employer. There are companies out there that will work with you regarding COBRA compliance, IRS compliance, including providing Form 1095-C to the employees. So you can outsource those employer responsibilities if you would like. The Obamacare tax penalties for the year 2016, the individual responsibility payment penalty is now $695 per adult, half that per child, up to a maximum of $2,085 per household, or you will pay the higher of that, or 2.5% of the household income. So if a household income was $100,000, 2.5% of that would be $2,500. You would pay the $2,500, not the $2,085 right above that. Section 105 is another code that we find very helpful when dealing with business owners or executives of companies where they're trying to maximize their dollars out of their corporation, out of their agency. For you as an individual, perhaps, you can utilize Section 105, which is commonly known as a medical expense reimbursement plan. But there are a number of other things that it may be referred to, as you can see, a health reimbursement arrangement, a health reimbursement account, healthcare reimbursement plan, a MERP, a medical expense reimbursement plan, medical reimbursement plan, Section 105, tomato, you know what the deal is. It's called many, many things, but the bottom line is this, is that the Section 105, it allows for amounts received under an accident or health plan for employees treated as amounts received through an accident or health plan. Purposes of Section 105 allows for these unreimbursed expenses. So not the actual benefits that come from the insurance contract, but deductibles and co-insurance and things that the employee or executive have to pay out of pocket can be reimbursed by the employer to the employee for medicines and drugs, prescriptions, dental office visits, vision benefits, things of that nature that are under Section 213D of the Internal Revenue Code. In other words, unreimbursed medical, dental, vision, all can be made whole at 100% to those executives. So this is kind of a quasi-self-insurance arrangement. Really works well, especially if you've got a smaller company, say a closely held family organization with 2 to 9 lives. This is a perfect way for you to go in there and show them how to maximize their deductibles so that it drops the premiums to their lowest point. And then for those unexpected, unreimbursed medical, dental, vision expenses, you can use Section 105 to take those deductions at 100% above the line. So a very useful code, especially when you're talking to high earners that are interested in tax efficiency. This is very, very attractive to people like that. Something else that we find that's very attractive to people that are in companies where they are making the decisions. Let's say that they have a title, they're an officer, they're an owner, a VP, someone who's considered a key employee of that company. Naturally, the smaller the company, the easier it is for you to reach those people. So we're going to concentrate on the 2 to 19 life marketplace. I want you to think about someone who you know that is in a position where they are able to earn good money. They may have 10, 15, 20 years of earnings left, as far as a couple of decades of work, looking to put away some money on a supplemental income retirement basis. They know Social Security is maybe not going to be what it used to be for them, and they're asking themselves, how am I going to prepare for retirement? And how can I do that on the most tax-efficient basis? There are a couple of non-qualified deferred compensation strategies out there, but we're going to focus on 3 of them this morning in this webinar. The executive bonus under Section 162, what's commonly referred to as a GEBA, or a Golden Executive Bonus Arrangement, and then a GEM, which is a Golden Executive Match. What are these 3 concepts? And I want you to really think about the concept, not so much as the detail. In a nutshell, a Section 162 executive bonus is where an executive takes out a personal cash value life insurance policy and names a beneficiary. An example could be Indexed Universal Life. I should amend the slide to include any cash value policy, whole life policies, universal life, guaranteed universal life, and indexed universal life, things with cash value. The employer pays the premium for the life insurance policy. The employer turns around and takes a 100% tax deduction for the premium paid. the premiums that are paid are considered taxable income to the executive, to the employee. So that said, the employee is going to purchase life insurance on a net tax dollar. They are going to do that in today's world anyway. The thing that's missing here is that the executive could go back to their company and say, wait a minute, I don't mind buying life insurance on a net dollar, but why aren't we as the employer taking the deduction at a 100%? Because in order for me to get money to buy a life insurance contract, I have to pay income tax on that money. The employer is paying payroll tax to provide me that money. What the Section 162 does is allows that payroll tax to be erased from the equation. Now the employer is able to get a very sizable tax deduction, which of course is very attractive in their mind, and just a smart way to do business. Why wouldn't you do that? So for, again, those companies of say 2 to 19, 2 to 25 lives, where you know the decision makers, where you're able to get to the people who are driving the revenue in that company, these tax strategies are very, very attractive for those people. Another thing, just to kind of simplify the concept, there are no contribution limits. You've got a $100,000 premium you want to deduct through your company, fine. You got a $150,000 premium you want to tax deduct through your company, fine. There are no premium contribution limits. Now, obviously, those kinds of cases are very few and far between and could create other problems where it may make it a modified endowment contract, or things that could go upside down if we put too much money in there. In every case, as individual, we'll work with you on structuring that case, whether that's through placing it in underwriting or with working with a CPA in order to maximize the tax strategies. We want to be able to help you with these cases. If you find people that qualify and you think of those people in your mind as we're going through this presentation, I want you to feel comfortable that you can contact them and say, hey, I found a sales idea. I've got a tax strategy that is really going to help your company. Feel free to call us and let us go out on a sales call with you, make these presentations for you, and show you that you can actually sell large life insurance premiums and make very good money in the process, not to mention do it on a tax-efficient basis and help people better prepare for retirement. There's no administration or startup cost, no minimum ERISA requirements, no government reporting, and the benefits to the executive are tax-deferred growth, tax-preferred retirement benefits, no penalties for early withdrawal, so if they need to take money out prior to age 59 and a half. Plus, it provides an income tax-free death benefit. So if a person dies prematurely, they have a nice transfer of wealth, income tax-free as a death benefit to their beneficiaries. Let's layer this next strategy. It's still a Section 162 bonus, but this time we're going to add in a few things that are going to put golden handcuffs. You've heard that term before. Golden handcuffs on a particular executive that's going to make them more likely to stay a period of time, not necessarily under an employment contract per se, but under a golden executive bonus arrangement, where we set up policy instructions where the employee retains the right to unilaterally change the beneficiary and exercise other policy rights that require the other things, such as changes to the policy may require consent of the business owner or the employer. So the employment agreement that is structured outlines what those rights are. The executive promises to make his or her services available until an agreed upon time. So for example, let's say at age 50, you've got someone who wants to retire at age 60 or at age 70. That structure may be a 10-year arrangement or a 20-year arrangement. This would be built into the employment agreement. The business promises to then pay a certain amount of premiums for the executive, which is also outlined in the agreement. And then if the employee or executive decides to quit before vesting, the executive may have to pay back some or all of those premiums. That arrangement, this golden executive bonus arrangement, becomes a contract between the employee and the executive, basically saying, hey, we want to help you retire, but we also want to keep you around for a while. We don't want you taking your talents elsewhere. Let's sign an agreement where, in good faith, we'll pay a certain amount of premium. You agree to stick around and help us build our company. That's the golden executive bonus arrangement. Now, the last of these concepts for deferred compensation on a tax-efficient basis is involving what's known as a golden executive match. Same thing as the GEBA. The executive takes out a life insurance policy. The employer then pays a tax-deductible cash bonus to the employee that matches what the employee originally paid in taxes on the income used to pay the premium. Now, let's reword that. The match mimics tax deferral for the premiums paid on the life insurance policy. All right. In other words, if I need $25,000 as a deposit, the employer might pay $40,000 to the executive. The executive would then get taxed on the $40,000. The net of that $40,000 would be the $25,000 that the executive would pay. The employer writes off the full $40,000. The executive gets a net of $25,000 and pays the contribution. So in essence, this golden executive match concept pays the income tax on the executive's behalf. Does that make sense? Now, continuing on with this concept, again, optional policy instructions may accompany the policy which restrict the employee's access to certain things like cash values as outlined in the employment agreement if golden handcuffs are desired, and we'd recommend that. Since the employee will own the policy, he or she may use the policy's cash value on a tax-preferred basis, and of course, if the employee dies prematurely, the death benefit is payable to the beneficiary. And of course, there could be different beneficiaries. In some cases, it may be a split amount between kids or heirs, maybe a split amount between a trust and a business. That's up to you as a life insurance financial planner to really understand what their needs are and then address those by naming the beneficiaries appropriate to the case. Now we're going to talk a little bit here for the next few minutes about how you can use a 1040 tax return to identify sales. And I want you to know that of the resources that we've used here, Lincoln Financial Group provided us with some outstanding material recently, very, very timely, up-to-date, cutting-edge marketing material. We're going to share all of this information with you. So you're going to be getting links, hyperlinks, that will take you to the PDFs that I use to make these next few slides. And we encourage you to read through those, maybe take 30 minutes to an hour and get in a quiet place and just kind of think through these concepts. And again, think about those key executives or people that are in a situation where they may want to buy life insurance on a tax-efficient basis to supplement their retirement income without all the hassle of a 401k or worrying about if their 401k is top-heavy. Those are the people I want you to think about as we go through these next slides. The first thing that you're going to get is a 4-page document titled Tax Impact. Identify opportunities, how taxes are affecting your client's retirement plans, and how you can protect their wealth. That protection of their wealth becomes a tax-efficient strategy that is outlined in these 4 pages here in this PDF, the Advisor Guide. Going through on the second page, what they'll do is they'll walk you through a Form 1040 tax guide. And it's going to help you identify areas where your clients could benefit from more tax-efficient strategies. It's going to give you, as an advisor, a more comprehensive picture of each client's financial situation. And it's also going to provide you with an added value service that you can use to really give you that edge when trying to develop new relationships or extend existing relationships. Certain levels of expertise are going to be required. And again, I'm not asking you to become a CPA. But frankly, as an insurance agent, it's of your best interest to become familiar with some of the more common tax strategies that are going to be used to make those tax-efficient decisions. So, for example, if we scroll down here, they break it down, and they'll show you on line 8A and 8B, if there's income in these 2 fields, they're going to see these are ideas and ways you can defer taxes on some of the money to save for retirement. So when comparing taxable versus tax advantage returns, you need to be sure to take a marginal tax rate into account. A higher tax rate means more taxes, making tax advantage investing even more important to that person. So again, the higher the wage earner, the more interested they will become in making sure that they are doing things on a tax efficient basis. Lines 9A and 13, Can also help to reduce the taxes that you pay on dividends and capital gains from taxable mutual funds by moving those funds into tax-efficient funds or holding retirement savings inside a qualified plan like an IRA or an annuity. The brokerage has 19 different annuity companies with close to 200 different annuity products. We'd be more than happy to help you with some of those annuity strategies as well. Then on line 15B and 16B, if you do not need your income from the IRS imposed required minimum distributions, RMDs, it may make sense to consider distribution planning. You can find opportunities to defer some of those taxes on lines 15B and 16B. Keep in mind those people that are turning age 69 to 70, those are the key people that you need to start talking to about making sure that by age 70 and a half, that they've started to take their required minimum distributions. If they don't, that's the #1 mistake people make, and they're charged a 50% tax penalty. So simply put, if they have a $10,000 RMD they forget to take, they're going to have a brand new $5,000 tax penalty that they will have to pay, and they will also have to take that distribution of $10,000 and pay whatever appropriate income tax level they are at the time of that distribution. So it goes into more details here on lines 15B and 16B. Then they bring up lines 20B and line 32, where it talks about things like paying taxes on Social Security benefits. Well, if you've got somebody 65 or older, they may or may not be on Social Security, but that's part of your fact finding. You need to ask that question: have you taken Social Security? Are you paying taxes on that? Yes. Would you like a more tax efficient way to distribute that money? Of course. Line 20B helps you identify sales opportunities there. And then on line 32, depending on the age, income, and tax filing status, you may be able to take a full or partial deduction for contributions that you make on an IRA prior to April 15th of any given year. Keep in mind also that if you're age 50 or older, you're able to take an additional catch-up contribution of $1,000 to that IRA. So again, not trying to make you a CPA, but just becoming familiar with a few basic things that will help you to work with your client's accountant and attorney as being a part of that financial team to help optimize their tax and estate planning strategies, potentially increase their income with those strategies, and of course strengthen those professional relationships. We all know that when you strengthen these relationships, two things happen. One, you're going to make more sales and help that person with some of these strategies. And number two, they're probably going to go tell people about what you did for them, and they will be more likely for referrals, good qualified referrals that'll come your way. Birds of a feather flock together, don't forget that. Lines 40, 43, and 50 are outlined here, where you can talk to people that may be the beneficiary of an IRA and what cashing it out might do to create tax liabilities. If you're a surviving spouse, how do you roll over those IRAs and make sure that you're doing it in a tax-efficient basis? And also, IRA beneficiaries may be able to take these itemized deductions equal to the estate tax paid on the IRA. So these are areas on line 40. If there is a number in that box, dive in a little bit. Ask the questions that make the answers pertinent, like, hey, tell me about your IRAs, because they've got them. If they're filling in box 40, you need to be talking to them about that money to make sure they're doing the right thing. There may be ways that you can roll that money into a life insurance contract that could perhaps pay out a benefit, an advanced death benefit for critical illness or long-term care, as an example. Line 43 is where it's participating in a company-sponsored retirement plan. If that box is filled up, hey, tell me about your 401k, or do you have any other safe harbors that you might be able to tell me about through your employer? And then on line 50, saving for your children's education and receiving potential tax benefits, 529 tax planning, where that money can be put into a tax-efficient vehicle like a mutual fund, and then those increases in that mutual fund can be distributed on a tax-efficient basis for educational purposes. So line 50, that tells you they've probably got kids or grandkids. What are you doing for tax planning for those particular people in your family? And then finally, the tips for talking taxes with your client with the bottom of page 3. They talk about Schedules A and C and how that might be additional tax advantages for small business owners and sole proprietors. People like you that are on this call might be filing Schedules A and C. take a look at your own tax return and ask that question of yourself. Am I doing things personally on the most tax efficient strategy? You can also see here with line 64, line 76A, and line 79, where you can prevent certain penalties or other things for withholding to make sure that you're taking out a proper amount of money in your income each month or however often you're paid. So again, how do you take a 1040 and make this something that you work with your clients and really begin to open up the questions that you need to ask to make sure that those people are utilizing you on a tax and your knowledge and having the most tax efficient strategies in mind. Again, I want to remind you that if you have questions, go ahead and ask those in the right side, the GoToMeeting toolbox where it says questions. You may ask those there. Again, we'll try to answer some of those now, but we also will follow up with you and give you additional information if we don't have enough time. The next couple of slides I'm not going to go over, but they're kind of bonus slides. Wanted to make y'all aware there's a new concept called myras.com, kind of a play off of an IRA, but for people with lower income. There are also new ABLE accounts, ABLE Achieving a Better Life Experience, which could be similar to the 529 college planning strategy, but for people who may have disabilities, making sure you get the maximum deductions there. Student loan interest paid by parents. Think of those people that have kids that may be in college. The student liable for the student loan can be eligible for up to a $2,500 deduction on student loans paid by their parents. So that's something that you might want to look at a little bit further. Reinvesting the dividends, being able to boost your tax basis for the mutual fund shares, and the automatic reinvestment of these dividends will help save money at the time that you redeem those shares. So you would only have to pay capital gains on the taxes those dividends once at the time you cash it. So that's another strategy, reinvesting those dividends. And then, of course, some of the people on this phone call, I know that you are Medicare age or older. Make sure that you're getting those deductions for your Medicare premiums as well as the cost of the Medicare supplement plans or Medicare Advantage premiums that you may have. And anything, of course, that exceeds the 7.5% of the unreimbursed medical under the adjusted gross income. And if you itemize your medical expenses, keep those things in mind as well. And of course, you also have the options of child care credit, where people can deduct certain things through their reimbursement account at work. All right, so you may be able to talk to employers to make sure that they have a flexible spending account strategy as well. Opens up the idea to businesses to get you in the front door to talk about things that may lead to other sales. And then the estate tax on income in respect of a descendant. If you inherited an IRA, a couple of tax strategies that you might want to put in there as well. And then finally, the American Opportunity Credit, credit that's good for all 4 years of college. And there's certain things that you may be able to deduct here as well. So again, just a couple of ideas to help you out, with any of these younger families that are out there planning for college. Gives you a chance to get in there because they're probably in their 40s, late 40s to 50s, and maybe on the prime end of their earning years, looking for a couple of ideas that they may be able to use to give them some ideas that find money to help them purchase insurance products to help them supplement their retirement. Last slide here, a couple of codes that you might see popping up, Section 7702B and Section 101G. These are real important when it comes to paying out benefits through a life insurance contract. You want to make sure you have a little bit of work and knowledge here. 7702B is going to be more for things related to long-term care. Section 101G is going to be things more for living benefits like critical illness. And this is especially important if you want to make sure you're paying these things out, because if you run out of money in a UL product, in some cases it may cause tax consequences. But if they're being paid out under qualified long-term care expenses or critical illness expenses, for example, using these codes, and the policy runs out of money, those tax liabilities can go away. So again, just to make you aware of a few codes that are out there, some things that we see and read about on an almost day-to-day basis. At this point, I will say that I have enjoyed looking into these codes myself and seeing how they could apply to certain sales strategies. I hope that you have too. That's the purpose of this webinar. We're going to go ahead and wrap it up and let you get back to your busy day. I want to thank you for your participation and look for that follow-up email outlining some of these sales strategies here over the next 24 hours. Thanks again, and we'll see y'all later.